All right, guys. As you know, we won't have class today. I'll be on the road. So we'll have today's class remotely on chapter 5, which is uncertainty in consumer behavior. So we'll talk about measures of risk, preferences of risk, ways to reduce it, trade-offs, and the amount of risk people are willing to take. We'll also describe risk and then talk about demand for risky assets and some examples about deterring crime and business executives and how they choose risk. So, describing risk is really a probability, likelihood that a given outcome will occur. You ever go to a parking meter and not have a quarter on you, and you run the risk of getting a ticket and betting that someone's not going to come by and give you a ticket while you're in the store or wherever you're at. You're making a probability weighted outcome. Like, hey, what's the cost of the ticket? Against the probability that I'll get a ticket. So the likelihood that a given outcome will occur. One objective interpretation of probability relies on the frequency on which certain events tend to occur. So using that parking ticket example, you're like, hey, I'm only going to be in there 15 minutes. I don't see anyone on the sidewalk giving tickets. I can probably run in and out of here without getting one. Now, we all know there's still a chance that you do get one, but that is a probability weighted decision. There's also subjective probability. That's the perception that the outcome will occur. So again, that's looking both sides of the street. Do you see any meter maids? So you said, all right, well, there's like only a 10% chance I'll get a ticket because I don't see anyone coming and I'll be in and out within 15 minutes. Expected value, that's a probability weighted average of the payoffs associated with all possible outcomes. The payoff is the value associated with the possible outcome. So here it's just giving us expected value of success and failure. If it fails, you get 20. If it succeeds, you get 40. But what are the individual odds of that? So failure, high chance of failure, small chance of success at 25%, which leads to an expected value at 25. And that's exactly how you would weight a probability weighted outcome. So you're like, hey, I could pay $20 for the parking lot, but or I could run the risk of getting a ticket, and the odds of getting a ticket are 10%. So you say 10% times 4 is only $4. Like I'm better off maybe risking it getting a ticket than I am paying for parking in that example. Variability, that's the extent to which outcomes occur of an uncertain event. So here it's talking about people's choices on income versus a flat salary job versus a commission-based job. And that can, drastically alter someone's incentives. It can also tell you a story about the risks that person is willing to take. Because there's a risk people are willing to take or say they'll take can often differ from, the actually risk they are willing to take. You can see here that in the commission job, in this example, they pay the same salary. So, if you had the same outcome, you would certainly choose the one with lower variability. I'd rather have a fixed salary than a commission salary if the expected outcome is the same. Why not just choose certainty over uncertainty? There can be strong deviations, right? When you're on a commission job, right? The best will do really well and the worst will do really badly. Standard deviation is the technical term, square root of the weighted average of squares of the deviations of the payoffs associated with each outcome from their expected value. But, in reality, standard deviation is just the risk, or how we measure risk, the spread around the average. So if the Celtics had an average score of 100 and they had a standard deviation of 10, that means within one standard deviation or 2/3 of the time, the Celtics will score between 90 and 110. So the average adding on that spread, right? Two standard deviations, right, would be only 95% or 5% of the time. You would get between 80 and 120. It would break those bands. So, if you had a choice, you'd choose something with an equal outcome with a lower standard deviation. The outcome probabilities for two jobs, so it's showing job one and job two. Job one has more stability your pay is pretty stagnant around that $1,500 mark. And then you see job one, which has much more varied outcomes. And then there's also unequal probability outcomes. So the distribution of payoffs associated with job one has a greater spread with a greater standard deviation than distributions associated with job two. There's also behavioral biases that will come into play here. Someone will believe they're good at sales, and because they believe they're good at sales, they might take the riskier job because they think they'll get the higher outcome and not the average outcome. Decision making. Suppose we had $100 to each of the payoffs in the first job, so the expected payoff increases from 15 to 1,600. So what it's saying here now is that everything should be done on expected outcomes, but if the expected outcome of the sales job is now higher, even though it's riskier, you might now say, hey, the expected outcome is higher here. Why not choose job one? Job one has the expected income of 1,600 with a standard deviation of 5. And that's kind of part of the answer. Some people still might not choose that job, even though the expected outcome for the average worker is higher. The spread is still rather large compared to job two, which has an average salary of 1,500 plus or minus effectively $100. Job one offers expected higher income, but is much riskier than job two. An aggressive entrepreneur might choose job one, but someone who's a little bit more risk averse will choose job two. People's attitudes towards risk affect many of the decisions they make. Fines may be better than incarceration in determining certain types of crimes. Other things being equal, the greater the fine, the more a potential criminal will be discouraged from committing that crime. The size of the fine that must be imposed to discourage criminal behavior depends on their attitudes towards risk. I mean, you could bring this all the way back to parking tickets, right? If the parking tickets were 5 or 10 or even $20, you'd be like, I'll never pay for parking. I'll just run the risk of getting a ticket. So, once parking gets more expensive, they raise the ticket prices because they know that, economics are at work in that kind of function. This is on preferences towards risk. In this section, we're going to talk about utility that the consumers obtain from choosing among different risky buckets. Expected utility is the sum of all the utilities associated with all possible outcomes. And remember, utility is like the benefit is kind of an academic term. We generally don't weight utilities, not like a real number, but it's almost like satisfaction from each outcome. So in our example, a consumer has an income of 15 grand is considering a new but risky job that will either double her income to 30 or cause it to fall to 10. Each has a 50% probability, so what is that person to do? The new risky job is preferred because the expected utility of 14, though, is greater than the assumed utility of the current job at 13 and a half. So it has a higher, we would say maybe risk adjusted return or risk adjusted satisfaction. Risk averse, this is a great chart here. Someone who is risk averse, condition of preferring a certain income to a risky income with the same expected value. So this is someone who has maybe they win more at the casino, they put more money in their pocket and they start gambling less, right, as they win more because they're risk averse. A consumer's marginal utility diminishes as the income increases. So as they make more money, they actually take less risk, but when they're not making a lot of money, they're willing to take a little bit more. This is risk loving. This is kind of the opposite. The more income they make, the more risky they get. So they prefer risky income to certain income with the same expected value. So this is someone who's risk loving. She would prefer the same gamble to the certain outcome. It says risk loving here again, but this is more risk neutral. It's a misspelling because of the chart here. So apologies for that. But this is someone whose risk and income move up in proportion. So they're risk neutral and they're indifferent to the certain and uncertain events with the same expected income or utility. Risk premium, that's the maximum amount of money that a risk averse person will pay to avoid taking a risk, right? let's say you're at that parking situation, you have no quarters, you see there's a parking lot for $30, and you know if you get a ticket, it's 50. So, what's the most you'd be willing to pay in like a parking lot to avoid that $50 ticket, right? Or someone's willingness to buy insurance could be another factor here, right? Those are the kind of things to consider when looking at something like this, like the risk premium. It's almost like buying insurance. How much are you willing to pay to avoid risk? Or how much, like, if you want to, do you want a salary and a bonus? If you get no bonus, maybe ask for a higher salary, right? Risk aversion income. The extent of an individual's risk aversion depends on the nature of the risk and on the person's income. Other things being equal, a risk averse person prefers smaller variability of outcomes, really tight spread around outcomes. We saw that when there are two outcomes, an income of 10,000 and an income of 30,000, the risk premium is 4,000. Now consider a second risky job, also illustrated in figure 5.4. With this job, there's 50% probability of receiving an income of 40, with the utility level of 20 and a 50% probability of getting 0. The expected income is again 20 grand, but the utility is only 10, right? And that's because, it's higher risk, so it's not as useful, right? Because the probability of getting 0 is not desirable at all. This is risk aversion and indifference curves. Part A applies to a person who's highly risk averse, and increase in this individual's standard deviation of income requires a large increase in expected income if he or she is to remain well off, while B applies to a person who's only slightly risky. An increase in the standard deviation of income requires only a small increase in expected income if he or she is to remain equally well off. Are business executives more risk loving than most people? So I think these studies are always interesting. Like, how do they define a business executive? Is it just someone who's a manager, or is it the owner? Is it the founder? So, the first thing about the data is I question, like, how they define a business executive. But in the study, they asked about 500 executives to respond to a questionnaire describing, different risky situations that an individual might face as a vice president of a hypothetical company. The payouts and probabilities were chosen so that each event had the same expected value. So a lawsuit, customer threatening to go somewhere else, a dispute with employees, and a joint venture with another competitor. The study found that executives vary substantially in their preferences toward risks. More importantly, executives typically made efforts to reduce or eliminate risk, usually by delaying decisions and collecting more information. Diversification, we know this from investing, but the practice of reducing risk by allocating resources to a variety of activities whose outcomes are not closely correlated. So, if you're thinking about, you have two businesses that aren't correlated, maybe you own a restaurant and an accounting firm, right? Like those two businesses, don't intersect well with each other. Or like, you're an accountant or you're a teacher, right? Like teachers usually do well when the economy is doing bad. And because teaching is a counter-cyclical business. And, accountants usually have more jobs when the economy is humming. Negatively correlated variables that have a tendency of moving in the opposite direction. So that's how you generally get the best diversification. But sometimes diversification like reduces profits as well. So you have two negatively correlated businesses. When one's doing well, the other is not. Stock market, first we'll talk about a mutual fund. And we'll discuss this more in class, but there are basically a pool of funds of individual investors to buy a large number of different stocks. It's just way more efficient to, if you don't have a ton of money, to pool your assets together inside a mutual fund and, buy this stuff together. Positively correlated variables, that means they move together in the same direction. So if you think stocks, for the most part, a lot of stocks move in the same direction. When the market's up, your stock's up. When the market's down, your stock's down. But how correlated it is to everything else will like cause it to move differently. For a fun exercise, if anyone wanted to look up two stocks that are not very correlated, that might be, like Amazon and General Mills cereal, right? Like almost not correlated at all. In fact, I will pull that up and show you right here, just so you guys can see that with your own eyes. So if we see this here, here's General Mills and Amazon over 5 years. Depending on the time period, you're right. Amazon had a 2 year run of outperformance, and General Mills almost had a 2 year run of outperformance just because they're almost not correlated at all. But that's what diversification is, owning both of these assets so that if you need cash flow, you can or you should be able to sell something that's up or doing well when the other is not. So this is a pretty decent example of negatively correlated assets. Going back to the slides, the law of large numbers. Insurance companies are firms that offer insurance because they know that when they sell a large number of policies, they face very little risk and they avoid risk by operating on a large scale. Like if you insure one car, that's really risky, but if you insure 10,000 cars, you actually reduce your risk because you're collecting premiums for all those members or customers of your plan. This tells us that although the single events may be random and largely unpredictable, average outcomes of similar events can be predicted, with a law of large numbers. And there's actuarial fairness when the insurance premium is equal to the expected payout. As in the example above, we say that the insurance is actuarially fair, and that's characterizing a situation in which the insurance premium is equal to the expected payout. That's not always the case, especially, if you're paying into your insurance and you're not getting an accident, you feel like you're not getting the payout, but you own that insurance policy to reduce risk and you're paying to reduce risk. This talks about title insurance. Title insurance is like super interesting. A lot of people will buy it for their homes, but will never need it. Title insurance basically, in one, scenario, let's say you buy a house and then, 100 years after you, or, 100 years before that, it turns out it's on like an Indian graveyard. And the tribe comes back and says, actually, this land was sold to you fraudulently. So we actually legally own it and you don't own it. In that like bizarre, crazy scenario, you could theoretically lose your house. So people buy title insurance, I feel like on a $500,000 home, it costs like 2 or 3 grand one-time fee to buy title insurance. And I didn't buy title insurance on my last house. And the reason for that is I talked to the lawyer. I'm like, how many policies of this have you written? And he's like, oh, hundreds. I'm like, how many times has anyone ever needed to claim it? He's like, never in my career. So people are paying this small fee to avoid this huge potential catastrophe that has a very low odds of coming to fruition. So I looked at the expected outcome and I was like, it's not worth paying the 2 or 3 grand. Like this house has been bought and sold a dozen times. No one's going to come back and say this was fraud. So I think I can just pocket that money instead of reducing my risk. The value of complete information, that's the difference between an expected value of a choice when there's complete information and expected value when information is incomplete. So think about, like buying a used car. Like the seller has all the information. You only have incomplete information about the car. And therefore, because your information is incomplete, you might want like a discount because you don't know everything that's wrong with the car. You just know it's used. Where like the owner of that car knows that like the brakes need to be replaced or like the right blinker goes on the fritz. The value of information in an online consumer electronics market. Internet pricing comparison sites, obviously, guys, you guys lived through this, offer valuable information and resources to consumers. The value of the price comparison information is not the same for everyone and for every product. Competition matters, and the savings increase with the number of competitors. So if one company sells one item and they're the only one who sells it, online research isn't going to be too helpful. But if you're buying a commodity product that you can get at many different places, you should be able to search for a lot of different prices. Doctors, patients, and the value of information. Suppose you were seriously ill and required a surgery. Assuming you want to get the best care possible, how would you go about choosing a surgeon in a hospital? A truly informed decision would require more detailed information, the kind of information that might be even difficult to get. Um, more information often, but not always better. Whether more information is better depends on which effect dominates, the ability of patients to make more informed choices versus the incentive for doctors to avoid sick patients. So, like, let's just say you were looking for a doctor to do a surgery, and you found a doctor with 100% success rate. What this is saying here is like maybe the doctor has 100% success rate is because he rejects patients that fail, right? You can also say the same thing about lawyers, right? Like lawyers never lost a case. Well, maybe he only picks up cases he knows he can win. And that's just some of this underlying data here that you have to be careful of. I once met an investor and I talked to him and he's like, I've never lost more than 10%. And I'm like, well, you must have not made much money either if you cap your losses at 10%. And then, he agreed with that. So, the data can always be manipulated and deceiving. Assets, something that provides a flow of money or services to its owner. An increase in the value of the asset is capital gain, losses or capital loss. These are all good keywords for a future exam too. Risky asset is an asset provides an uncertain flow of money or services to the owner. Riskless asset provides a flow of money or services that is known with certainty. And then we have return, which is the monetary flow of an asset. And then there's real return, which deducts inflation. Expected return, return of an actual that an asset could or should return on average. And then there's the actual return, right? Like on average, the stock market earns 8.8%, but on a real basis. So, but that doesn't mean it will actually earn that over the period that you own the stocks. So just being careful here. It also says that stocks, while they return 8, the standard deviation is 20. What does that mean? That in 2 out of 3 years, the stock market returns about 9 plus or minus 20%. While a corporate bond, returns 3.3 plus or minus 8.4, a much smaller standard deviation. And that right there summarizes the trade-offs between risk and return. Because the return is risk-free on the T-bill, the expected and actual returns are the same. In addition, let the expected return from investing in the stock be RM, and then the actual for stock return be little r and m. This formula right here towards the bottom of the page is a super important finance and investment formula. So, at some point for a future exam, this will show up, and it's often called the CAP-M formula, capital asset allocation model. And it's basically the return of a stock. And this is basically a simple stock model. The return of a stock is defined by its beta, the stock's beta, multiplied by the average market return, plus one minus beta times the risk-free rate. And that would be the return of your portfolio. And they also call it the investor's choice problem. I apologize. Don't learn it this way. This is the better formula here. Return of the portfolio is the risk-free rate the risk-free rate plus beta multiplied by the return of the market minus the risk-free rate. That will be the formula I have you know for a future exam. The budget line is really the trade-off between risk and return, forming a line in that function, and it gives you an idea on the price of risk or price of risk, which is the extra risk that investor must incur to enjoy a higher expected return, right? You buy some Tesla stock because you hope it does well. But, it could also be down 25% in the last 2 months, right? So you're taking on a higher risk for a higher return. Very rarely will you get a higher risk or a higher return for a lower risk. And this is an example of that budget line, right? Like, hey, if I can earn more, I'll take more risk, is effectively, like you might say, hey, I'm not going to take a commission job. But, if I said, hey, the potential salary is 500 grand, you might be willing to take that risk. And the slope of the budget line is part of that CAP-M formula. These show 3 indifference curves. The only indifference curve that is valid is U2 because it sits along the budget line. U3 they can't afford, and U1 is too cheap. Investor A is likely highly risk averse in this chart because his portfolio will consist mostly of risk-free assets. His expected return will be only slightly greater than the risk-free rate. Investor B is less risk averse, meaning they'll take more risk and they'll invest a large fraction of their wealth into stocks and have higher volatility and also higher returns over the long run. This is showing an extreme example, like buying a stock with borrowed money. That's honestly a recipe for disaster, but it's just trying to show here an example of like someone with super high risk, right? Because when you add leverage, you're going to increase volatility and potentially increase returns. The problem with leverage is it can force you to go broke before you achieve those high returns. And this is just a slide talking about investing in the stock market, which we've talked about a great deal. We'll continue to talk about it in class. And the stock market has dives and rapid and long increases. You can have periods of euphoria. At the time of this recording, people are debating, is there an AI bubble? I don't think there is yet, but there's certainly like the ingredients for one to occur over the next several years, depending on how the market plays out. And a lot of people judge stocks by their price to earnings ratio. And if the PE ratio is high, meaning you're paying a high price for a certain amount of earnings, that could be trouble. Doesn't mean always it's trouble, but if you're paying a high PE, that means the company is expected to grow. And if you don't get the growth, then the stock will probably fall. And this is the dividend yield of the S&P 500 and different PE ratios. So the dividend is a cash payout. So in this period in the 80s, we had high dividends, but we also had low PE ratios. And then we have low dividends and high PE ratios. This doesn't really say one is right and one is wrong. Some of this is, I wouldn't call misleading data, but it's very a broad generalization. But what I like to think about it is there's periods when certain assets do well and different assets have different seasons of doing well. So it's always important just to consider, owning a portfolio or basket of different stocks with different exposures. I think I might have mentioned this in class, but if I bought the stock of Ferrari, I'm not going to buy the stock of a boat maker too, because those two assets will be pretty highly correlated. And that's the end of the chapter, guys. Thanks so much.